continuing for longer than expected. Well, let's go to Chicago. Standing by at the CME Group is Tim Evans. He's Chief Market Strategist at Longleaf Trading Group. Tim, good morning to you. So obviously the rout in crude really did have an impact on the markets through the overnight period. Tell us just specifically how worrying it is as a reflection of the overall macro environment.
Sure. Well, first, good morning in Australia. Thanks for having me on. Yeah, I mean, the nervousness in the market, I mean, you could feel it, you know, in the energy space, and which carried over into global equity markets. You know, if you kind of looked at a broad menu of markets today, you know, the U.S. dollar caught a bid and everything else sold off. So, you know, we were seeing a safety bid in the market early on, and that carried on throughout the day. And, you know, oil took the brunt of that.
And it comes down to, you know, supplies, demand growth, according to the EIA, and inventory. So really, I guess, painting this picture of surplus, lower demand, so lower prices. I mean, we had oil falling below that 45 US per barrel level. Do you have any idea, or do you have a range that you believe oil fundamentally should be trading in right now?
We're looking for oil to trade in a range from about $40 to $50. You know, I think the one thing that's kind of keeping the market from really falling apart, you know, is the threat or the idea that, you know, OPEC members can, you know, come to terms with non-OPEC members, i.e. Saudi Arabia and Iran, and agree to some kind of production cut. You know, I'm very skeptical on whether that can happen, but that threat, I think, does leave a little bit of support in the market, which, you know, in our view, should keep it right at $40 at a minimum.
But Tim, you know, as I mentioned in the preamble, U.S. producers have proved incredibly resilient to some of these lower prices. You know, we continue to see them pump. We continue to see rigs come back online. Give us some sort of a sense from where you stand about how long that can continue if we do, in fact, see oil prices declining.
Yeah, I mean, though you know, U.S. energy companies, shale producers have been incredibly resilient. A lot more resilient than any estimate that we had, or, you know, any other credible source that I read during those times. But I'd have to say that, you know, the cutbacks in U.S. energy. I mean, the point of that was, you know, the OPEC felt that they were losing market share. You know, and by losing market share, you know, they thought it threatened the future of OPEC, you know, the very existence and the profitability of OPEC as an organization. You know, the very fact that U.S. companies have, you know, proven to be so resilient, you know, I mean, I think OPEC is going to have to continue to produce and keep supply at the levels that we're currently seeing them. To really find out where that breaking point for U.S. shale is, because I don't think anybody really knows that.
Mm-hmm. Okay, let's just turn the conversation. I mean, there wasn't a lot of places for investors to hide through this Tuesday session in the U.S. As we head through the rest of the week, and you expect this volatility to continue, perhaps, where, I guess, would you be looking for opportunity in this market?
Well, I mean, with crude oil, I mean, if we continue, you know, it's kind of the perfect storm right now with, you know, for weakness in the crude oil market. I mean, we're concerned about interest rates possibly going higher the next meeting. There's just general overall concern about, you know, economic health, you know, concern about the effectiveness of a lot of these aggressive monetary policy programs that are in place. You know, so you have that coupled with the bearish supply and demand fundamentals. So, I mean, the news flow around crude oil right now is incredibly bearish. You know, I think if we continue to see the market pull down around that $40 level, you know, I fully expect to see strong technical support there, and you know, I'd recommend being a buyer at those levels.
Okay, what else are you watching, Tim? I know that your day is over there as you head towards tomorrow. What's on your agenda?
Well, I mean, again, as all of these markets are selling off, I mean, obviously all markets are not created equal. You know, there's various, you know, supply and demand fundamentals that affect individual markets and the sectors that they exist in. You know, but as these markets are all selling off so aggressively, you know, given kind of the risk-off sentiment that we saw today, it leaves certain markets more favorable on the buy side than other markets. And, I touched on this briefly a week ago when I was on your program, when I was talking about the U.S. grain markets. We had a USDA crop report yesterday that kind of got hidden with all the, the news of energy and the kind of condition of the market here over the last 24 hours. But, what that USDA report revealed is that, crop estimates are big. We're looking at the USDA making a revision from 48.9 to 50.6 bushels an acre, and that would be a record crop, a record U.S. crop. When we analyzed those numbers yesterday and really began to break them down, we questioned that increase, because quality ratings really didn't change from the August 2nd USDA crop report. So we're skeptical that the crop estimate should have been increased that much, and we expect to see a revision. So, on that revision, we would obviously, tend to see higher prices. So that could be an interesting buying opportunity in the soybean market as well.
Tim Evans, thank you so much for joining us. Appreciate your insights. Have a good afternoon.
Thank you, Nadine. You too.